Guys ready? There's a lot going on. I gotta catch up. Let's get going. Let's do it. Hello and welcome everybody to the Crypto Mining Show, your one-stop shop for all cryptocurrency news from the perspective of a cryptocurrency miner. I go by Matthew in real life and Blind Run on the internet. And today I have to catch up. I've been out for a little while, had some medical issues, etc. That aside, I'm feeling good today, starting to feel a little bit better. I wanted to catch up, make sure you guys know I'm alive. Sorry, I meant to change the scheduled stream last night to today. Didn't do it, didn't get around to it, and that is kind of the way it goes, but we're back and we're ready to go. So obviously, the biggest questions that have been going around is like all of the tariffs on cryptocurrency, miners in particular. And there was some talk surrounding, of course, the the Trump administration's policy surrounding chip manufacturers and removing tariffs on things like cell phones, computers, graphics cards, chips like that, if that applied to Bitcoin mining. My understanding right now, as of right now, thanks to a short from Hawk Crypto Mining, is that is not applied to Bitcoin miners. And I have an article here from investing.com we're going to take a look at and see what they say. It does look like my audio is peaking a little bit, so let me bring that down just a little bit so that we aren't peaking on you guys. All right. There you go. Let me know if that works for you guys. Oh, audio is fine. Okay. Then let me just turn it back up. There we go. All right. Let's pop into the first article. What is the effect of U.S. tariffs on Bitcoin mining? Investing.com. The United States reliance on Chinese manufacturers for Bitcoin mining equipment has made its mining industry particularly vulnerable to trade restrictions. According to Pat Zhang, head of research at WooX, Chinese firms control between 70 and 80% of the global ASIC hardware market, meaning a 25% tariff on mining equipment would have immediate financial consequences. This would increase the price of machines like the Antminer S19 by approximately $1,250 per unit, eroding profit margins, particularly for large-scale mining operations that require frequent hardware upgrades to stay competitive. Beyond the direct cost increase, higher tariffs could lead to supply shortages, especially if trade restrictions escalate to include outright export bans. While lower energy costs in certain regions of the U.S. could help miners absorb some of the additional financial burden, the overall effect would still be a slowdown in industry growth. Hardware shortages and delays would be another consequence, with the severity depending on the tariff rate. A tariff of 10% or lower would likely have a minimal impact, but at a 25% tariff, delays could extend to 2 to 6 months, slowing U.S. hash rate growth by an estimated 5 to 10%. If tariffs rise beyond 25% and are combined with additional export restrictions, supply disruptions could stretch beyond 6 months, causing the U.S. share of the global Bitcoin hash rate to drop below 30% and shifting mining dominance to other countries. Smaller and mid-sized mining farms would be hit hardest. Hardware costs typically account for 30 to 40% of a mining operation's total expenses, and a 25% tariff could raise overall mining costs by 1 to 2%. If tariffs reach 50 to 60%, costs could increase by 2 to 4%, making it difficult for smaller miners to remain profitable. A 25% tariff could reduce profit margins from 37 to 25%, limiting expansion but keeping operations viable. Now, in my humble opinion, that's not as big of a deal. The thing about cryptocurrency mining, especially stateside, is all about energy. That is why you see obviously huge price markups on miners when the price of Bitcoin is high, And that doesn't nearly affect, of course, operations as much as energy costs. So if the energy cost stateside comes down as significantly as promised by the Trump administration, I would presume it's not near as impactful for the cost of the miners themselves, especially if we are going to see Bitcoin start to go up and up again and hit its kind of second all-time high peak, which I'll talk about here in a little bit too. It does go on to say that, however, at 60%, margins could shrink to single digits, pushing some miners out of business. I don't think that's the case, right? Once again, it comes down to energy costs, in my humble opinion. As small miners struggle or shut down, U.S. Bitcoin mining activity would likely decline, leading to industry consolidation. That's all. That's already happening. That's already been happening for quite some time. And I don't know that, I feel like the bear market impacted that more as far as consolidation to the top. I don't think that it's near as impactful as the bear market was, if that makes sense. Because the thing is like, it really comes down to, once again, that profit margin of cost to mint Bitcoin at the end of the day. Now, I've been looking at cost to mint Bitcoin like with an S19 at stock. And one of the big problems there is that obviously there's firmware to make this better, which you should definitely do. But it's all the way as high as like right now, a cost to mint a Bitcoin at like 7.5 cents to 8 cents. Somewhere around there, like average hosting fees is going to be around 110 to 115,000 on a stock S19. And that's really where you want to see kind of Bitcoin get back up to for the smaller miners. And that's kind of how I see it. I think the bear market, the price of Bitcoin and the cost to mint is more impactful than tariffs on the cost of the mining hardware itself. I think when you're looking at these kind of investing.com articles, Forbes, all these types of financial, news outlets, is they don't know, I think, the industry quite as intimately as they might like to pretend they do. And I don't know, what do you guys think? Are tariffs as impactful as energy cost and cost to mint Bitcoin? I just don't think it is, especially when we're talking about smaller miners that are getting their equipment hosted, all that sort of thing, right? Let's go on though. It does say that a 25% tariff could cut profit margins by 11 to 15%, forcing some miners out of the market, while a 60% tariff would result in widespread closures. Larger firms have the resources to survive, but would face slower expansion, allowing mining operations in other countries to gain market share. If tariffs remain in the 10 to 15% range, only a small fraction between 1 and 5% of the U.S. hash rate would shift overseas. However, a 25 to 30% tariff could push 7 to 17% of miners to relocate, particularly mid-sized firms unable to compete with larger U.S. operations. And see, I haven't seen, we'll have to see like what they're basing these numbers off of as well. Actually kind of curious if they've listed any resources for this in particular. It doesn't look like it. Yeah. Anyways, so it does go on to say, with smaller operations forced out, the remaining hash rate would likely consolidate among larger mining firms. Like I said, I think that's already happened at this point due to the bear market, not so much tariffs. At tariff levels of 25 to 70%, between 10% and 35% of the US hash rate could end up in the hands of a few dominant players. If mining consolidates under U.S. firms, it could raise concerns over regulatory risks, including increased government oversight and transaction censorship. Tariffs would also impact Bitcoin's network security. A 10 to 15% tariff could reduce the U.S. hash rate by 5 to 10%, lowering the global hash rate by 1.8 to 3.8%. A 25 to 30% tariff could shrink U.S. mining activity by 15 to 25%, cutting global hash rate by up to 9.5%. If tariffs rise to 50 to 70%, the U.S. hash rate could decline by 30 to 50%, reducing global Bitcoin security by up to 19%. I think this is all fear mongering and BS in my humble opinion. But it says, while Bitcoin's network is designed to be resilient, such a significant reduction in mining power could increase the likelihood of network attacks or regulatory influence. Yeah, bullshit. This whole thing's bullshit. There's so much hash rate on the Bitcoin network right now that there's very low chance of any sort of network attacks in a 51% nature, right? It's just not. We could go look at, I guess, what would be the best? Luxor hash rate index, right? And pull that up right now. Oh crap, is it down? Here we go. Where's their, they used to have that site. This is their price data. Luxor hash rate distribution. I don't remember what they called it. Do you guys remember what they called it? Mining pool data? Is that it? See if that'll load there. In the meantime, Eugene said, tariffs as it stands now feels more like unsuccessful marriage, endless mind games with no real movements. Yeah, I mean, that's more of a comment on the nature of it overall. I'm really more curious, how it affects mining, right? So right now we are looking at China with 45.3% of the hash rate and the US at 50% of the, or 40.5% of the hash rate, right? So, really kind of competitive. I guess the argument they're trying to come up with is that China as a country could control over 50% of the hash rate, thereby affecting it from a censorship perspective of China being able to censor transactions. That would mean that they would have to have control over all of the individual miners. Can China coordinate that? I don't know. That seems extremely difficult to control, not only get all over 50% of the hash rate, right? But then also from a government perspective, have full control over every single miner in the country, and then also be able to execute that and point all of that hash rate to a single pool, right? Because you do have multiple Chinese pools that are available, including, of course, right here, you can see Ant Pool via BTC, Spider Pool, SEC Pool, and Binance Pool. In fact, you have more concentrated hash rate on a single pool from the United States with Foundry than you do with any other pool that's here right now. So I think this is a little bit of fear mongering. In my humble opinion, I don't see the network being compromised from a reduction in the hash rate on the state side, nor do I think that we're going to necessarily see that right away, because I got to go look at what the release time schedule for Bitmain miners are, but I don't think there's a significant improvement in hash rate efficiency right now from, Bitmain or WhatsMiner or anything like that would impact it this significantly, right? But yeah, so moving on, Bitcoin miner Bitfarms secures up to 300 million loan from Macquarie, an initial trank, or I don't even know how to pronounce that, of $50 million will be used to develop Bitfarms Panther Creek data center in Pennsylvania. So already, even though, and this is important, even though we're seeing, fear mongering for tariffs and whether or not people will be able to mine here or whatever, it is looking like people are still building out. Now, I think we did cover this one already, to be completely frank with you guys, because it's looking really familiar. I thought I got brand new updated notes, but apparently not. Let's see, when was this posted? This was on April 2nd. So this was covered already. So we're going to move on from there. Apologies. Here we go. More on the tariffs. Let's see from the perspective of Cointelegraph. It says Trump tariffs squeeze already struggling Bitcoin miners. And this is from Brain's executive. So, quote, it will take a decade for the U.S. to catch up with cutting-edge chip manufacturing, Brain's chief marketing officer, Christian, says. Now, this is obviously the big question would be, if tariffs go in place, chip manufacturing needs to get stood up in the United States so that the U.S. can be competitive. Like, how long does that take? And it takes a very long time to get chip manufacturing on the level of China. And that is, I think this is a more relevant concern when it comes to tariffs and their impact on U.S. Bitcoin mining in the future, though. Because everything that's been ordered up to this point, everything that's getting shipped over, that's kind of already gone through that process. I think like the Bitfarms standing up their HPC data center as well as their Bitcoin, that stuff's already been put into place. So I don't think any of that's going to shift. I think you'll see a slowdown in hash rate growth US side, but I don't think you'll see a big like cutoff, right? At the end of the day, the new trade tariffs announced by Donald Trump may place added pressure on the Bitcoin mining ecosystem, both domestically and globally, according to one industry executive. While the U.S. is home to Bitcoin mining manufacturing firms such as Auradine, something like that, it's still not possible to make the whole supply chain, including materials, U.S.-based. Chief Marketing Officer at Bitcoin mining tech provider Brains told Cointelegraph, and that's completely true. On April 2nd, Trump announced sweeping tariffs, imposing a 10% tariff on all countries that export to the U.S., and introducing reciprocal levies targeting America's key trading partners. Community members have debated the potential effects of the tariffs on Bitcoin, with some saying their impact has been overstated, while others see them as a significant threat. And like I said earlier, in the short term, I think the impact has been overstated. In the long term, it could be more impactful. But as was mentioned in chat earlier, by Eugene, the tariffs are more of just a negotiating tactic at the end of the day. And I don't know that any of those will stick. And until they stick, and until it's clear what industries they will impact, it's hard to say that it's going to have a massive impact on this right now, right? So he did go on to say that the mining industry is already experiencing tough times, pointing to key indicators like the Bitcoin hash price. Hash price is a measure of miners' daily revenue per unit of hash power spent to mine Bitcoin blocks. It has been on the decline since 2022 and dropping to all-time lows of $50 for the first time in 2024. And I actually already have that chart pulled up here. Where was it? Yeah, so right now, it's back on the rise, right? It got down to a low on April 7th of $39. And today, it is sitting at $44. So it's still down $6 from the time this article was written. So that's important to note, I suppose. It's continuing to go down. And this is important because the hash price is the key metric miners follow to understand their bottom line. It's how many dollars 1 terahash makes a day, a key profitability metric, and it's at all-time lows right now. He added that mining equipment tariffs were already increasing under the Biden administration in 2024 and cited comments from Summer Meng, general manager at Chinese crypto mining supplier Bitmars. Quote, but they keep getting stricter under Trump, he added, referring to companies such as China-based Bitmain, the world's largest ASIC manufacturer, which is subject to the new tariffs. Trump's latest measures include a 34% additional tariff on top of an existing 20% levy for Chinese mining imports. In response, China reportedly imposed its own retaliatory tariffs on April 4th. It was also noted that cutting-edge chips for crypto mining are currently massively produced in countries like Taiwan and South Korea, which are hit by new 32% and 25% tariffs, respectively. Quote, it will take a decade for the U.S. to catch up with the cutting-edge chip manufacturing. So again, companies, including American ones, lose in the short term, he said. He also observed that some countries in the Commonwealth of the Independent States region, including Russia and Kazakhstan, have been beefing up mining efforts and could potentially overtake the U.S. in hash rate dominance. Quote, if we continue to see a trade war, these regions with low tariffs and more favorable mining conditions can see a major boom. Of course, Kazakhstan still has a major energy problem, like we've talked about before. I'm not so sure they even have the infrastructure to... Here's the thing: is like Kazakhstan doesn't have the infrastructure to support mining at the level that the U.S. infrastructure can support it. And you can say, okay, well, obviously it would take a long time for the U.S. to catch up to the chip manufacturing rate of these foreign countries. At the same time, it would take those foreign countries a lot longer to catch up to the energy capacity of the United States. And once again, I go back to my original thesis, which is that cost of energy matters more. Period. End of story. Cost of energy matters more. The cost of the Bitcoin miners, you can take a 25% increase all day long as your energy cost is the lowest and you have the highest capacity. That's the argument. This argument of like these tariffs are going to destroy the mining industry in the US, I don't believe it for 1 second. We have the power infrastructure. We're lowering our energy costs. The cost of miners going up 25% means fuck all. End of story. So I like it doesn't even make sense. It's like they're completely ignoring the fact that Kazakhstan had to like impose laws to stop people from Bitcoin mining because the power infrastructure wasn't there. Now, the power infrastructure is there for China. That's going to be the biggest competitor. And we'll have to see where it goes from here. Obviously, China's spinning up all their coal plants, but we're starting to do that too. I don't think you're going to see a third player come into the mix that's going to compete with the United States at the end of the day, right? It's just, we're so far ahead from an energy perspective that it's not even funny. It's like us and China. Russia's going to take a long time to catch up too. I just don't think that this is as big of a deal as people are making it to be. Says Trump's stance on crypto has shifted multiple times over the past years. As his administration embraces a more pro-crypto agenda, it remains to be seen how the latest economic policies will impact his long-term strategy for digital assets. Let me know what you guys think in the chat. If you think I'm going down the right path with this theory that energy cost and infrastructure matters more than anything else when it comes to Bitcoin mining, and a 25% increase in the cost of the hardware itself is negligent or like negligible at best, right? That's my thoughts on this. But, you know, I could be wrong. I've been wrong in the past plenty of times. I just don't think it's going to be as impactful as people think it is, right? Now, here's the thing too. So there's been that shortage of miners, but they're all starting to get released now too. And US authorities have begun releasing these. I talked about this last month already, but I just wanted to bring this up once again because these are miners that are going to be again being deployed now, right? And over the past few months, they've been getting released. And as they get released, they're going to be coming online. So I wouldn't be surprised if we start to see, of course, like hash rate begin to increase overall at the end of the day. I'd have to go look at, I mean, even we could go to mining pool stats, right? I wanted to check this earlier. Bitcoin's up today too, a little bit, 84,000. Yeah, I mean, we just had a tick up in difficulty, a pretty significant one. So, I mean, miners are getting deployed pretty heftily, it looks like. I need to go back further on the chart, but we're at an all-time high difficulty. And most of that's getting deployed stateside. So it doesn't look like any of these like fears in the short term are accurate whatsoever to me, right? And evidence of that, by the way, mining difficulty has risen 6.8 0.8% as Bitcoin hash rate hits a record high on April 5th. We are at 121.51 trillion on the difficulty, and hash rate is peaking. At press time, the Bitcoin network's computing capacity is gliding at 876 exahash a second. We're up to over 900 exahash a second now, slightly below its recent peak. This record-setting hash rate arrives as mining difficulty edged up by 6.81%, raising the bar for miners attempting to validate new blocks. The current spot hash price, the projected daily return for 1 petahash per second of SHA-256 hash power, stands at $44 today, $46 on April 5th when they wrote this, and that hash price has fallen 11.15%. At this pace, the network needs to adjust just 117 exahash a second to cross the threshold of 1 zettahash per second, a milestone that appears likely to be reached in 2025. Currently, 883 exahash translates to 883 quintillion hashes per second, or 0.883 zettahashes per second. This record-setting computational high coincides with a lull in transaction activity as recent blocks remain largely unfilled. Of all the blocks mined in the past 24 hours and the total revenue collected, less than 1%, specifically 0.89%, originated from on-chain fees. And this is a big problem, by the way, guys, because obviously what we are experiencing, and it's going to be really interesting to see how this plays out, but everything is decreasing quite significantly on the use of the blockchain. And remember what I've said before is the halving will stop affecting the price of Bitcoin when fees meet parity, right? So when miners get paid out the same amount in block rewards as they do in fees, that's when we will break out of your traditional halving cycle. And we're going the opposite direction because everybody's beginning to hoard their Bitcoin, right? And all the Bitcoin is being paper traded with things like ETFs and so on. That means, to me, the time horizon for a super cycle is pushed out further and further, right? I was thinking maybe 2 more cycles we would see it, but at this point it's looking like if this is the way people are going to begin treating Bitcoin, which is purely as a store of value, you're going to have less price movement and more effect from the halving schedule, or a continued effect from the halving schedule. Now, I've kind of modified my price for Bitcoin because it looks like we hit that first all-time high with the like $110,000 mark. If you look at previous cycles, you kind of see a second run up, and I think we saw the first run up. We're about to have our second, and I think we'll be in that 110 to 115 range. And it might not go up to that $210,000 mark that I've thought it was going to go to in the past. I think it's been affected quite a lot by this thought of it being a store of value. And because everybody is perceiving it that way, and even Satoshi had talked about this in the forums, is that if people start treating it that way and governments start holding it and large corporations start hodling it, it will basically lose its purpose, and at the end of the day, its inherent value will be decreased. It's almost built into the network to behave this way if it's not being utilized as a currency. So utilization has to come back into Bitcoin before it can really see the same increases in price that it's seen after halvings previously. So our halvings will be less impactful over and over and over again, but they will remain to be impactful because of the lack of fees being utilized on the network, if that makes sense. So you're still going to be seeing like a halving schedule. You'll see lower and lower all-time highs every halving, and it is impacting the rest of the altcoin market pretty negatively too, because, you know, we say the rising tide raises all ships, But if you're not having the euphoria on the Bitcoin side, then you seem to begin lacking, of course, the all-time highs on the altcoin side, which is what we're experiencing, right? Outside of new cryptocurrencies, let's say like, your Caspas, your Lithiums, those sorts of things that weren't around during the previous bull run. Outside of those, previous cycle altcoins are not trading at all-time highs and have not gone through an all-time high this cycle yet. By and large, I know there's a couple of outliers, but by and large, that's been kind of the way it's been. And I'm not sure that we will see those things happen again. We've talked about this before. A lot of what happened is that, Solana took over, the meme tokens took over, took a lot of the liquidity out of the market, and the market as a whole on the altcoin side lost a ton of trust. And when they lose all of that trust, it's like, well, obviously you're not going to have those same euphoric effects that you had in the past. It is what it is, right? Now, Coinbase stock is facing its worst quarter since the FTX collapse, sparking potential buy opportunity. Coinbase's stock price plunged nearly 50%, occurred alongside broader U.S. stock and crypto market downturns. While the drop may appear to offer a compelling entry point, investors should be cautious before assuming the stock is undervalued. Coinbase Global has had ups and downs since its Nasdaq listing in April of 2021. The company quickly became the largest publicly traded crypto exchange, catering to retail and institutional investors. In 2024, Coinbase reported impressive revenues of $6.3 billion US dollars, more than double the amount from 2023. Most of these revenues stemmed from transaction fees, $4 billion, with the remainder coming from subscription services, including offerings like stablecoins and crypto staking. That's pretty bad. Look at that chart. However, the crypto market has been through a rough patch recently, contributing to a significant decline in Coinbase's valuation. As a result, its stock is now trading at a relatively lower price to earnings ratio of 24 times and an enterprise value multiple of 11.7 times based on 2026 earnings estimates. Yet, as with many crypto companies, Coinbase's earnings are highly unpredictable, mainly because they depend on volatile prices and trading volumes of crypto assets. A key factor in determining the firm's long-term value will be its ability to diversify its revenue streams, mainly by reducing its dependence on transaction fees tied to the fluctuating market. While Coinbase has potential for growth, it will need to adapt to make its revenue model more stable. And here's the thing about it. We have more options. It comes down to Phantom Wallet. The ease of use of Phantom Wallet for onboarding without being tied to a centralized exchange and its increase in downloads compared to your traditional cryptocurrency exchange applications like crypto.com and Coinbase is a direct impact to this. So you want to ask me why this is happening? It's because you can onboard crypto without going through crappy exchanges that rob you with their fees, and people that are getting into crypto now are going directly to a decentralized version. And if you really wanted to onboard, you can use things like PayPal and Coinbase now, so you don't even have to go through any of these exchanges, and you can get straight into decentralized markets without ever touching this. And because the trend has been meme tokens on Solana once again, most of the liquidity is going straight through Phantom and not hitting any of these centralized exchanges. Other than like the old heads that still have the apps loaded on and are waiting to buy Trump token on crypto.com or Coinbase, it's really less of an impact. It just is. And I think that this is just a reflection of the shifting landscape for cryptocurrency and the move towards directly onboarding in a decentralized manner without having to go through a third party, which was the entire goal of cryptocurrency in the first place. So congratulations, we're going the right direction as far as that's concerned, right? Coinbase is currently trading at 24 times the price to earnings ratio at 11.7 times, blah, blah, blah. We read this already. This is a significant drop from a month ago when its share price was nearly 50% higher at $298. The current multiple is lower than that of key exchanges like Nasdaq, ICE, and CBOE, reflecting the volatility of Coinbase's profits. However, the company holds $4 billion in net cash and is expected to remain cash generative. Consensus estimates around $2 billion annually for the next 2 years. This steady cash flow makes it a good candidate for estimating its fair value using a discounted cash flow model, DCF for short. DCF valuations are sensitive to assumptions like revenue growth, volumes, pricing, and competition. Finamize analyst Russell Burns mapped out 3 potential scenarios for Coinbase's future: a base case, bull case, and a bear case. The base case assumes 29% revenue growth this year, followed by 15% growth through 2026 and slower growth thereafter. This scenario suggests Coinbase's fair value is around $197, which is near its current trading price. Assuming a crypto market surge, the bull case could see its fair value rise to 400. My argument would be, just in general, that the bull case would not be as impactful as they think it would. I would cut that down to 300 to 350, right? Because at the end of the day, onboarding into crypto is not going through Coinbase and crypto.com anymore. It's evidently by downloads metrics on iOS and Android going through directly through Phantom Wallet now. And that's just how it is these days. In the bear case, with stagnant growth and regulatory challenges, fair value could drop to $80. That's massively low. This highlights the importance of the volatile crypto market in determining Coinbase's valuation. Despite these variations, Coinbase's stock is heavily influenced by crypto prices, particularly Bitcoin. The company's stock has historically moved in sync with Bitcoin, which will likely continue. However, due to high expectation, Coinbase's stock has underperformed this year, despite increasing crypto volatility. Factors like lower rewards and custodial fees and missed expectations for inclusion in the S&P 500 have also contributed to its recent struggles. Over the past 3 months, 20 Wall Street analysts have provided 12-month price targets for Coinbase Global. The average price target is $330, with a high forecast of $475 and a low of $195. This average target implies 81% potential increase from the current price of $182.95. The most recent long-term forecast predicts that Coinbase's price will reach $200 by mid-2025, followed by $300 by mid-2026. In 2028, the price is expected to rise to $350, $450 in 2029, $500 in 2030, and $600 in 2033. Now, here's the thing. I'm going to say it again. We are not seeing the same increase in the price of Bitcoin influenced by the halving that we've seen in the past. And seeing that we are running out of steam for this bull market and the effects of the halving cycle, and 2026 projected to essentially begin the next bear market, if we're still going off of the halving cycle, which, because fees have not met parity with block reward, is probably going to be the case. I would say that I would more likely be inclined to short Coinbase stock than to buy and hold, or hold it as a future, right? So that's just me. I don't play around in the stocks other than having a 401k. And that's kind of how I see it, right? Obviously not investment advice either. It's just my kind of thoughts as far as like, will you see $300 in mid 2026? No, because mid 2026, I think we're going to start to see downturns in the crypto market based off the halving cycle. Could I be wrong? Yeah, maybe we are breaking out of it completely, and the entire landscape shifts and changes, and everything goes in a direction that we've never seen before. Completely possible, but I don't know. WX2 in chat says, the things I have to spend Bitcoin on, I use the Lightning Network with Speed Wallet and Cash App, for example. Other things, gear, rigs, I pay for with Litecoin. People need to start looking at least, start using at least some of it. Yes. And like I said, when I was looking at like some of the posts from Satoshi on like the forums, and one of the things that had been brought up was this idea of governments and corporations holding Bitcoin and hoarding it all. Well, when you hoard it all and nobody else is using it, well, the value of that asset goes down because nobody's using it. And that seems to be a danger for Bitcoin and the wider crypto market at this particular time. Just is what it is, right? And hash rate's going to an all-time high. People were expecting a bull run that did not hit the expectations. And I think that once again, it's just another reason why tariffs are not going to be that large of an impact on US-based crypto miners at the end of the day. It's all going to be energy cost. So if the Trump administration gets energy costs down, win for US-based mining and loss for everybody else. And that will be the story that we read in a couple years. If energy prices continue to rise, we do not stand up and re-energize the old coal plants and start moving into, nuclear and bringing our cost of energy down stateside. That will be the largest indicator in impact on Bitcoin hash rate on stateside mining operations over anything else. And so it really depends on if that plan is going to go through and be successful. If it's not going through and being successful, then it's a moot point, right? The other part about all of this is that it's making it extremely difficult for anybody to get into mining at all. And because the altcoin markets aren't being influenced nearly as heavily by the halving cycle as they have in the past, the altcoin mining side is also struggling, as evidenced, of course, by your, GPU mining revenue, which at 7 cents a kilowatt hour is having the latest and greatest GPU from NVIDIA, the 5090, only profiting 28 cents per day. If you go up to the national average, which I don't know why you would even mine at this cost of 15 cents, well, you're losing money across the board. I think more reasonably, if you are in a decent area like Texas or something, at 10 cents a kilowatt hour, barely in profit with a 5080 on Conflux at 8 cents a day. And the mining and holding strategy is not working anymore. And it won't work. I've talked about this before. The problem is all of the new money that's coming in is not going through centralized exchanges. The influence on the altcoin market was due to cryptocurrencies that were available on centralized exchanges, also having Bitcoin and people FOMOing into those alternative cryptocurrencies because all of the money is getting funneled through Phantom and Solana. All of the money is headed into that liquidity over there, completely ignoring centralized exchanges and thereby completely ignoring other layer one proof of work cryptocurrencies. Because people just don't see them. Out of sight, out of mind. And so outside of a project taking over and showing worth and use cases, outside of that, you can't expect a project that's not getting worked on and actively developed and being competitive to be profitable. So what do I mean by that? I mean, like Ravencoin, for example, probably a very low likelihood compared to, maybe something that at least has easy access to tokenization, etc., or something that has extremely high transactional use cases like Litecoin, which was mentioned before, or something like Caspa, etc. And yes, Hawk, I mentioned your short earlier. I already gave you a shout out as far as that goes. And we already did say that, yes, that is the tariffs are not, or that the tariffs do impact crypto miners. My point, just to reiterate once again, Hawk, since you just got here, here's my thought on the whole tariff thing. The price of a Bitcoin miner does not matter as much as electricity availability and cost and infrastructure. And the US infrastructure for energy far surpasses any other country. So other than China, there's no other competitor to the US, and Bitcoin miners stateside can weather a 25% increase in cost of equipment because it does not have that much of a bearing on your actual cash flow, right? So it'll have a little bit of an impact, but not near as much. it will impact the smaller miners. It will impact, miners that are getting their equipment hosted. Yes, but I don't think it'll impact everything else, right? So that's my thoughts behind it, and I'm still going to stand behind that. I think overall, the U.S. just has more energy. And like I said, if the Trump administration brings the cost of energy down, thereby reducing the cost to mint a Bitcoin, that will have a greater impact on stateside crypto mining than a 25 to even 100% tariff. Because every single time we see Bitcoin go up in price, the price of the miners go up significantly, and that is still not that big of an impact on miners in general. The bigger impact is cost of energy, right? We all know that at this point. So in a new public ruling from the SEC, this is pretty huge. They have confirmed that stablecoins are not securities. Now, remember, proof of work cryptocurrencies were labeled as not securities, which was a huge win. And now stablecoins are not being considered securities, which is just another huge win. Back-to-back decisions coming from the SEC. Stablecoins backed by cash or cash equivalent reserves and redeemable for US dollars on a one-to-one basis are not securities under federal law, the SEC said on April 4th, offering one of its clearest positions yet on regulatory treatment of crypto. In a public statement, the SEC's Division of Corporation Finance outlined its legal view on what it termed covered stablecoins, a category that includes fiat-backed digital tokens designed to maintain price stability through fully reserved dollar holdings. According to the division, the offer and sale of stablecoins do not involve security transactions and therefore do not require registration under the Securities Act of 1933 or the Securities Act of 1934. The move is likely to provide legal clarity for stablecoin issuers, fintech firms, and crypto payment providers that have long operated in regulatory uncertainty. Now, according to the SEC, covered stablecoins are designed and marketed solely as tools for payments, money transmission, and value storage. They do not grant holders interest, profits, governance rights, or ownership claims, and are typically described as digital dollars rather than investment procedures. Oh, you stupid pop-up. No. So the SEC emphasized that these tokens are not promoted as profit-generating instruments, a key distinction under federal securities law. The regulator's conclusion was based on two landmark legal standards, the Reeves versus Ernst & Young test and the Howey test. Under Reeves, the division found that covered stablecoins more closely resemble instruments used for routine commercial transactions rather than speculative notes or debt securities. The agency pointed to the buyer's non-investment motivation and lack of trading for profit as key reasons the tokens fall outside the securities definition. The SEC also applied the Howey test, which examines whether an arrangement involves investing money in a common enterprise with an expectation of profit from others' efforts. The agency found that covered stablecoin holders are not investing for returns and that the economic reality is that of a consumer transaction, not an investment contract. And just for fun, PiCoin fails that fucking test, so... According to the SEC, covered stablecoins must be redeemable for USD at a fixed price at any time and in unlimited quantities. Additionally, issuers must maintain a fully backed reserve consisting of cash or liquid, low-risk assets such as U.S. Treasury bills. These reserves must be segregated, not used for the issuer's business operations, and safeguarded from third-party claims. In some cases, issuers must also publish proof of reserve attestations to verify solvency and transparency. Obviously, that's something that's been needed to be done for a long time. While covered stablecoins may trade on secondary markets, their price is typically stabilized through arbitrage. If the market price rises above the peg, designated parties can mint new tokens and sell them for a profit, increasing supply and lowering the price. Meanwhile, if the price drops below the peg, they can buy tokens at a discount and redeem them for full value, decreasing supply and lifting the price. Now, this is a question about yields remain. These SEC highlighted that holders of covered stablecoins do not receive any form of yield or share in earnings generated from reserved assets. While issuers may earn interest on the assets held in reserve, those earnings are retained by the issuer and not distributed to token holders. Key difference when you're talking about things like Picoin. It will be interesting to see, regulatory clarity on proof of stake in particular. I think that's up in the air as it pertains to like Ethereum and node operators, etc. The commission emphasized that the absence of yield or financial benefit removes a key element of the Howey test, namely the expectation of profit derived from the efforts of others. By clarifying that covered stablecoins are not marketed as investments and offer no upside participation, the SEC drew a line between fiat-backed tokens used for utility and those marked with return-generating features. Need I tell you why or give you any example of what that might be? BitConnect! You got to be really careful with those things. The agency noted that tokens promising returns, profit sharing, or exposure to an issuer's financial performance could still be subject to securities laws. The statement does not extend to algorithmic or uncollateralized stablecoins, which remain subject to further legal and policy consideration. Nonetheless, the announcement marks a key milestone in delineating the regulatory boundaries of digital dollar equivalents. So there you go. Stablecoins are not considered a security. And coming off the back of proof of work not being considered a security, we have two big wins coming from the SEC as far as regulatory clarity. Unfortunately, it doesn't seem to be impacting the price of crypto positively by that much. Mixed martial arts champion Conor McGregor launches a meme coin. Have you guys heard about this? McGregor and the project's team highlighted the fairness of the sealed bid auction approach compared to conventional meme coin launches. MMA champion Conor McGregor launched a meme coin called Real on April 5th, which will reportedly feature staking rewards and voting rights for token holders. Spokespeople for the project told Cointelegraph that the token was launched through a sealed bid auction to eliminate snipers and bots hijacking the token launch. The project was developed in collaboration with the Real World Gaming Decentralized Autonomous Organization. Here are the tokenomics. 31.5% to the DAO Treasury, 16.5% to the community, 13.5% to the seed sale, 10% to the team, of course, because, they got to have something to dump on the community. 7.5% community staking, 7% private sale. That private sale so they can dump on the community. 3.5% strategic sale, 3.5% community airdrop, and a 3% Sex Dex liquidity stake, and then 3% public sale and 1% advisor. So if you're part of the 3% public sale, well, you're screwed, buddy. You're going to get dumped on so hard. These things need to stop. They need to stop. It's getting ridiculous. And this is what happens when you are a washed up fighter. Get out of here, Conor. Scamming people with your crap. You could still beat my ass, though. It's fair. I'll run, but I'll get a gun. It's fine. This is not some celebrity endorsed bullshit token. Yes, it is. It is a real game changer that will change the crypto ecosystem as well as make real change in the world. No, it won't. The sealed bid auction is the new way of launching a token to prevent rug pulls and snipers. Is anybody still buying these things? Oh, there's a video. Where can I watch the video? Can we look? Has Real been released yet? No. When does it get released? I guess I would have to check ape.pro or something. Let me make sure it's not logged in. Okay, it's not logged in. What's the damn contract address? Let's go to Twitter. Hold on. Twitter, X. Sorry, whatever. It is what it is. Conor McGregor. There's too many Conor McGregors, and I don't know which one is which. Oh, I don't know, man. I'm either blocked or... I'll have to look into it more. Did the article have a contract address? The notorious MMA. Here we go. I was trying to look on his deal here, but Get Real Token. There we go. Found it. GetRealToken.io. Here's the video.
Notorious nearly never happened. You want the real story? The McGregor story could have been about a lad who never left Dublin. I manifested greatness. I fought. Beat the best of me.
Oh, that's exciting.
Become the realest man in the octagon. The biggest draw in the world. The first real fighter to cross over sports. The first champ. After all that, you think I'm going to give up now? Get real. Failure isn't fatal. Success is never final. I'll just keep going.
Just keep
Knowing
going.
I wrote this story.
Just keep going, bro. Just keep going.
Notorious nearly never happened.
Stop. We saw it already.
You want the real story?
Ah! Mute that quick. Oh, no. The token launch has been paused. Every bit has been fully refunded. This is not the end. They done f***ed up already, dude. They done f***ed up. Look at those tokenomics, bro. If you're part of the 3% public sale, you're so screwed, dude. Don't buy this shit, man. Don't do it. That is so funny that it's already paused. They're like, bro, we can't do it. We're done. We don't know. Look, it'll be back. Don't worry. You think I'm going to stop now? I think you should stop now. Let's get into some GPU news. There are more details from the 9070 GRE, and it will feature 12 gigabytes of memory. The most interesting part about that is that it does get a cut down memory bus to 192-bit from the regular 9070, which maintained the 256-bit that the 9070 XT has, and puts it at only a measly 480 gigabytes per second of memory bandwidth, which is just laughable for mining. Completely pointless card, in my humble opinion, for mining. It is what it is, you know? I mean, 5070s even above that with the 672. And that's a 192-bit bus, but they got the GDDR7. AMD's fallen behind in a lot of aspects. Obviously, where they're really kicking ass is on the SoC side, integrated graphics side. That's where they're really focused. And then obviously the CPU side of things. FSR 4 is a game changer on the 9000 series. I will give them that. They finally are catching up to DLSS, which they really needed to do. And the fact that they can implement those into future launches of the Steam Deck is going to be very important from that aspect, which is really what I think it's going to be focused on, plus the new consoles. If we get the Xbox handheld, which is supposed to be coming, PlayStation 6, those types of things, that's really where they're going to be focused. AMD and Radeon have been focused in that direction already for a very long time. And this is just, frankly, disappointing, but expected at the end of the day. If you compare this, to any GPU that's currently available, I don't think that you're really going to find a major benefit over the 6000 series. And we didn't see a benefit from AMD on the 7000 series side, right? So from the mining perspective, AMD hasn't had a good launch in 2 generations for mining, unfortunately. So I don't know what to say about it other than I'm a little disappointed. I do want to get a 9070, but mainly the 9070 is going to go into my HTPC for my bedroom gaming setup that I have, so I can have FSR 4 and run SteamOS on it, because that's what I do over there. Now, the 5060 Ti specs came out as well. And so those are here. We are getting 16 gigabytes of GDDR7, which is extremely exciting from the mining perspective. And that will, the problem is it's on a 128-bit bus. So it's only going to have that 448 gigabytes a second. The thing is, compared to the 9070, right? The 9070, when we take a look at that, we have, I believe, did they list the power? They didn't list the power. I thought I had seen the power for this. My understanding was we had a much lower power requirement on the 5060 Ti compared to the 9070 GE, right? So the 5060 Ti is going to have 180 watt TGP, which could offer some benefits. It'll be an interesting mining card. But the more enticing one will be the 5060 from the memory perspective, because it maintains that 448 gigabytes a second of total bandwidth with a total GPU power of 150 watts, which is 30 watts lower than the 5060 Ti, making an interesting choice for things like Ergo, obviously. And it'll be a lot faster than the 4060 Ti and 4060 on things like Ergo, right? So there you go, as far as that's concerned. And then finally in GPU news, the 9060 XT features 2048 cores and a boost clock of 3.2. And this one's going to have 128-bit bus of GDDR6, only giving us 320 gigabytes a second of total bandwidth. Unfortunately, a little bit disappointing. We don't have power numbers for it yet, but compared to a 5060 Ti or 5060, really not going to be there, not going to be hitting what we want to see. Like I said, I think AMD and Radeon is really focused on perfecting FSR 4. Unfortunately, on the gaming side too, NVIDIA has really been focused on less raw horsepower improvements and more feature improvements, things like DLSS, encoding, AI sort of applications, that sort of thing. And so we're not getting that raw power, rasterization power that we used to see generation over generation. It's been a very boring space for a very long time. About 2 generations on both sides, with the latest generation of NVIDIA being more enticing, just frankly for the GDDR7, which really isn't even something you could attribute to NVIDIA fully, That's more due to the fact that we got new memory, and that's really the important part at the end of the day. Surprised, Radeon hasn't adapted or adopted GDDR7 yet. It would have made this generation a lot more interesting for mining comparisons. Unfortunately, my content's just not going to be that interesting on the GPU side because Radeon's just falling behind and NVIDIA's getting too damn expensive, brother. Too damn expensive. On April 9th, the U.S. Treasury Secretary Scott Bessent announced that the government will examine regulatory challenges related to blockchain, stablecoins, and the new payment systems. This statement was made during a speech and indicates a focus on understanding and potentially addressing regulatory impediments, there we go, in these areas. The announcement has sparked discussions and speculation within the cryptocurrency community about possible future regulatory reforms. Now, we've already gotten, the SEC to give us regulatory clarity on proof of work cryptocurrencies as well as stablecoins. Tokens are up in the air. That's really going to be the thing that I think is going to be a token by token basis with hopefully some regulatory guardrails that are clear to where we stop getting all of these meme tokens, right? Here is the statement.
Close look at regulatory impediments to blockchain, stablecoins, and new payment systems. And we will consider reforms to unleash the awesome power of the American capital market. Americans deserve a financial services industry that works for all Americans, including and especially Main Street. Under President Trump's leadership, the Treasury Department and I will deliver that to you. Thank you.
All right, so there you go from the man himself. Like I said, it's really going to come down to what happens with tokens. WX2 said, so based on your testing, what is the best bang for your buck gaming card? Right now, 6900 or 68 or 6900 XT. It depends because I've seen used prices of the 6900 XT like really, really good. And then I've seen them shoot up. It just depends because from a gaming perspective though, that's what I have in my system over here right now. It works with bazite.gg right out of the box. You get FSR3. It's not worth going to 7000 series. 9070 might be enticing, but I haven't tested it yet. So that's where I'm really at. And sorry about the volume on that video. It's just a quiet video. I couldn't turn it up anymore, but it is what it is. It is what it is. Ethereum's not been looking very good. I think it's a little up right now. Let's take a look over the past month. Yeah, a little down. Wonder why that would be. Would it have anything to do with World Liberty Financial selling ETH at a loss? What are you doing, Trump? On April 9th, 2025, a wallet possibly linked to the World Liberty Financial, a company associated with Donald Trump, sold 5,471 Ethereum at a price of $1,465 each, totaling $8.01 million. Previously, World Liberty Financial had purchased 67,498 ETH for approximately $210 million at an average price of $3,259 per ETH. This recent sale represents a significant loss of about $125 million from their initial investment. The transaction has sparked a range of reactions within the cryptocurrency community, from disbelief and criticism to discussions about potential buying opportunities. I don't know. I don't know why you would buy a bunch at 3,000 and then sell it off unless you lose confidence or something along those lines. And unfortunately, Ethereum's just struggling and it continues to struggle. And I think it's going to be really interesting to see what the SEC has to say about proof of stake because we still don't have that regulatory clarity. If it goes the wrong way for proof of stake, Ethereum could be in significant trouble at the end of the day. It's already down 48% for the year. If we compare that to Bitcoin, we can compare these out here. You can see back in July of 2024, we start to see, pretty big failures from Ethereum to keep up with the price of Bitcoin. And of course, if we went back to 2023, let's do all. It had looked a lot better. I'm trying to see how I looked at that before. Anyways, it looked a lot better until, of course, the move to proof of stake in 2023, September, right? Yeah. So, I don't know. Anyways, is what it is. Could look worse and worse for them, of course, at the end of the day. I do have, we had talked about miners a little bit. A big piece of news that I did want to cover, because we have been talking about Pi Network, is if Pi can succeed without a major exchange, and apparently there's not going to be a listing for Pi on Binance. Pi Network launched with a bold, although somewhat far-fetched mission: make cryptocurrency mining accessible to anyone with a smartphone. It's not really mining, but whatever. No expensive hardware, no complicated setup, and just a simple tap once a day, like an addiction or something. While the idea would have Hal Finney turning in his grave, the concept gained traction quickly, drawing in millions of users around the world and building one of the largest crypto communities to date. Naturally, as interest in the project grew, expectations around listings on major exchanges, especially Binance, began to build. In fact, more than 2 million of Pi Network's users participated in a community poll in early 2025, with 86% voting in favor of pursuing a Binance listing. Yet, as of April 2025, Pi Network's native token, Pi, is still not listed on Binance, the world's largest cryptocurrency exchange by trading volume. In fact, there's not even been an official statement from Binance. It's a bit like knocking on a neighbor's door for help and watching the curtain twitch, but no one ever opens. So why has it not been listed? Unofficially, concerns have circulated within the broader crypto space since Pi Network's mainnet launch in February 2025. Critics point to artificially inflated user metrics, Ponzi-style dynamics, obviously, centralized control of the network and tokenomics, or the lack thereof as dead giveaways. I mean, the biggest giveaway, like, do we really need to show this again? But we'll do it again for anybody that hasn't seen my previous videos. As you, oh, dear Lord, this thing's a fucking mess, dude. The FDV is $66.1 billion with a current circulating supply market cap of $4.54 billion, which is already way overpriced. With a total supply slated to be $100 billion right now, that gives you the fully diluted value. It's just not sustainable as more unlock. Obviously, a big unlock is coming in July too. So we will probably continue to see, poor performance from the Pi token. That would be my bet. Don't trade, but it is what it is. If I can get a mod to ban that Boris dumbass, that'd be cool. If not, I'll go over and ban him. Let's go grab it. All right, Boris, get the F out of here with your scam. We already know what the OKX wallet scam is. Been there, done that. Continuing back on the Pi network here. Binance's vote to list initiative favors projects built on the BNB smart chain. Pi network operates on its own blockchain, so it doesn't meet the core eligibility criteria. Binance expects clear and public disclosures about how a token is issued, locked, or burned. So far, Pi has not provided the level of detail that major exchanges typically require. Without that transparency, it's difficult for platforms to assess the integrity of the token's economics, which are obviously a mess. You can look at that and see it. It's clear as day on CoinMarketCap. And in regions like Vietnam and China, Pi Network has come under scrutiny for operating in the way that resembles multi-level marketing, which I've addressed in the past. That kind of classification introduces regulatory uncertainty, something major exchanges prefer to avoid. And while Pi has made its way onto other platforms such as OKX, BitGet, and MEXC, none of them bring the same level of exposure or liquidity. Without access to Binance's massive user base and credibility, it's hard for Pi to gain serious traction in the broader market. Since then, Pi's price line has been choppy. Short-lived spikes have mostly been driven by speculation, often around mainnet rumors or exchange teasers, but they've consistently been followed by corrections. The token has struggled to maintain upward momentum, and trading volumes remain thin compared to more established projects. The Pi core team has said it's been working on its improving transparency and tightening up regulatory side of things. That's a step in the right direction, but whether it's enough to win over Binance or any other top-tier exchange is still up in the air. Pi Network does have certain advantages that could allow it to grow without relying on top-tier exchanges. First, its user base is massive. Of course, there's skepticism surrounding that user base. Pi claims tens of millions of users, numbers most crypto projects would kill for. Of course, I guess they have KYC. I'd like to see the KYC numbers. How many people are KYC'd would be the biggest indicator as if that number is accurate or not. Of course, if you KYC'd yourself for Pi, well, you're not a cypherpunk and you need to get the fuck out of my channel. Just kidding. I'm kidding. Don't worry about it. It's okay. It's okay. Don't KYC yourself though. Come on, dude. So, second, the Pi core team has emphasized real-world usage. Through campaigns like PiFest, it has tried to prove that Pi is a functional currency as well as a speculative asset. Over 125,000 merchants reportedly signed up to accept Pi during the March 2025 event. That sounds pretty good. Even though the actual payment volume remained flat, the infrastructure is at least starting to form. The team also continues to build its own ecosystem, wallets, decentralized applications, and even a proprietary KYC system, rather than relying on third-party platforms or validators. If Pi can evolve into a closed-loop economy where users earn, spend, and exchange Pi within its own environment, major exchanges may not be as critical. Now, my theory has been we're moving away from, centralized exchanges as seen in the drop in stock price for Coinbase, as we see the app downloads for Phantom skyrocket past that of Coinbase and Crypto.com. There is an argument for the idea that centralized exchanges will become less and less impactful on the success and from a price perspective on individual cryptocurrencies. And that would be my biggest argument for, Pi in general, right? In theory, Pi could carve out its own lane, not as a speculative coin trade on open markets, but as a digital currency used in peer-to-peer economies and low-cost marketplaces. Despite the initial hype, Pi Coin's performance since its mainnet launch has been dismal. The token is facing major inflation pressures. Over 124 million Pi is being unlocked in April alone, with a total of 1.53 billion entering circulation in the next year, pushing the supply to over 8.2 billion. Meanwhile, the migration process is broken. Only a fraction of users have been able to complete KYC and access their coins, with many reporting lost tokens or endless verification loops. While smaller exchanges like OKX and BitGet list Pi, tier 1 platforms like Binance, Coinbase, and Kraken have steered clear. The lack of transparency from the Pi core team on development milestones and token economics only deepens user frustration. At the end of the day, the thing is tokenomics don't lie. A fully diluted value of 44 billion is unsustainable, and the real price of Pi token, at the end of the day, best case scenario, outperforming Caspa, outperforming every other layer 1 currently in existence. Even if it's outperforming all of those with its fully diluted value, the price would have to come down to like 4 cents per Pi. So just take that into account, right? And at 4 cents per Pi, you're talking about a $4 billion fully diluted value. And there are massive success, way more successful projects that are not even close to that, right? So it's just from a mathematical perspective, it just doesn't make sense, right? Like there's not enough users. There's way too many tokens, and everything is inflated by everything being locked up, and these incentivized lockups, etc., requiring KYC to unlock tokens, delaying people from being able to unlock them, thereby delaying them from, essentially selling them. All of that is going to cause a lot of issues for the Pi token, and I don't see it getting any better, frankly. I just see the price continuing to go down until it reaches, like pennies below 10 cents. And then at that point, we could discuss if it will be viable in the future or not, right? But as of right now, you don't want to be, buying a bunch of Pi token. Obviously, if you're mining it, you've KYC'd, that sort of thing. Like I've said in the past, I would probably just sell it as I can sell it from what I've mined. That's how I would treat it until you're at a point to where it has upside potential and a majority of the liquidity has been unlocked. So that's kind of how I take a look at it. I am going to call it for today, though. Thanks, everybody, for hanging out. Don't forget to hit the like, comment, subscribe, notification bells down below. I'll be live again. But don't forget, I'm going to be live a little bit more exclusively over on twitch.tv/blindrun. So go follow me over there if you want to hang out with me, maybe playing some video games, doing some things like that. Love you all. Have a fantastic day. Have a good week. Have a good weekend. And I will see you next Tuesday.